Robinhood is trading lower in its public debut with just around, 45 minutes to go until the closing bell. It's off 5%. We want to talk a little bit more about this debut with Charles Spatt. He is a professor, or Chester Spatt, a professor of finance at Carnegie Mellon's Tepper School of Business. And Chester, it's great to speak with you. I guess first, just your initial take on the reaction that we're seeing in the market today. There was lots of hype going into this public debut, yet we're seeing the stock off just around 5%. What's your take?
Well, I think my take is that the offering was perhaps overpriced. There were some rumors this morning, for example, that Goldman was having a hard time getting the allocation finalized, that perhaps there was a shortfall of orders. I also thought an interesting aspect of the allocation was the proportion that, at least tentatively, Robinhood planned to set aside for its own customers. That could reflect a number of things. It could reflect as a business strategy, trying to make being a customer of Robinhood more valuable. It could also reflect perhaps a perceived shortfall in institutional interest and demand.
Chester, help us understand how big a threat, if there is a threat, to their business model on this, that you pay for order flow. Could the SEC really change this? Because lots of firms do this, and I thought legally it had been established as this is perfectly legal, go forward.
Well, I wouldn't want to predict that the SEC couldn't move forward on changing payment for order flow, but payment for order flow has been with us for a long time. It's certainly been with us throughout the last several decades in the modern capital markets. Some observers say it's been there for hundreds of years. You see payments that involve third parties and other types of pricing in all kinds of industries. But it's possible that the SEC could adopt standards that would be difficult to satisfy. That's certainly a possibility. If, on the other hand, the SEC simply requires enhanced disclosure, that probably won't jeopardize the Robinhood approach. In a sense, the customers do pay. They don't pay commissions, but they pay perhaps in the form of somewhat lower execution quality. And ultimately, currently this is viewed as satisfactory for the consumers. But I think how the SEC is going to handle these issues remains to be seen. It certainly has gotten a lot of attention in the aftermath of GameStop, for example.
Chester, what do you make of the competition out there? Because Robinhood almost seems like it's in a league of its own, just in terms of the brand recognition, how much it's resonating here amongst retail traders, especially those who are in the younger generations. I guess, how are you looking at that and some of the other names out there that could potentially rival Robinhood's business?
Well, Robinhood's not the only brokerage firm with free commissions. Obviously, a number of the other firms have offered free commissions, and in a sense, free commissions are low commissions are not that new a thing. Low commissions have actually been out there for retail investors for decades. But in the eyes of many investors, there's a difference between low and free. But Robinhood isn't unique in that regard. On the other hand, Robinhood's app certainly has, I think, captured the imagination of many investors. It's interesting from an asset perspective that Robinhood only has assets in its firm on the order of 1% of the assets of a BlackRock or a Vanguard, but clearly the Robinhood business model is very, very different. It's a brokerage model, of course, and it's a model that is focused upon high turnover and trading of those assets.
Chester Spatt, great to get your perspective. Professor of Finance at Carnegie Mellon's Tepper School of Business.